Well, the estimates, the first estimates of this year's GDP from the NSO, the National Statistical Organization, is largely on expected lines. We can run through. It's come in at 9.2% growth. That's their forecast against a minus 7.3 last year. That's very close to the CNBC TV18 poll of 9.3, RBI estimate of 9.5. The more important number is obviously the nominal GDP. We have been saying that has been estimated at 17.6% higher at 232 trillion rupees. Again, the CNBC TV18 poll was also 233 trillion. So entirely on expected lines. Let me quickly run you through the breakup. Agriculture 3.9 over a 3.6 last year. Very good numbers. See, all the manufacturing sectors have done well. Manufacturing up 12.5%, more than making up for last year's cut of 7.2%. Electricity more than making up for the 1.9% last year. Construction not bad, minus 8.6 last time, 10.7, not bad at all. The real cut comes in services, as you will see. Trade, hotels, transport, which took such a bashing last year at minus 18.2, not made up much. It's just 11.9% higher. Finance, okay, finance and real estate. Real estate must have helped a bit, up 4%. This is largely government and personal services like, education, hospitals. That's also done quite well compared to last year's cut. We can also look at GDP from the consumption angle. And from the consumption side, 6.8% growth in personal consumption is rather bad, not made up for last year's fall. Government consumption has done well, it's come to the rescue. And capital formation, very good, at 15% more than makes up for last year's cut. So what are my key takeaways from this? For me, the biggest takeaway is that the nominal GDP itself is higher by about 4.2 compared to what the budget estimated. So now 6.8% of this was the fiscal deficit. If you look at it at 6.8% of the larger number, then the government gets to spend about 65,000 crores more without flouting the fiscal deficit cap of 6.8%. That's important. The second big takeaway is that the real GDP at 147 trillion is back to FY20 levels. FY20 we did 145 trillion. But per capita GDP is at 1.07 lakh rupees per Indian. Now that, while it is higher than last year's 99,000 odd, it has not yet come back to the FY20 levels. So per Indian, we are earning less than before COVID. Taxes are actually higher this time. We know that from the fiscal data. So I won't be surprised if the actual GDP comes in higher, because GVA plus taxes is GDP. It's possible that we will get an upside surprise to GDP. And finally, the biggest grouse I would have is personal consumption is still lagging rather bad, not made up for last year's slowdown or last year's cut, but capex is good, and we may take some hope from that. Well, with those details, let me now invite our guests. Joining me to discuss the numbers, Dr. Pronab Sen, who was former chairman of the Statistics Commission, Dr. Latha Venkatesh, the senior advisor at the NCAER, and Nikhil Gupta, the chief economist at Motilal Oswal Financial Services. Gentlemen, thank you very much indeed for joining us. Well, Dr. Sen, to start with you, good news at least because the government can spend more. The nominal GDP is much higher than what the budget estimated.
Yes, I mean, good news in the sense that the government can spend more. Bad news in the sense that the government had actually forecast the inflation to be at 4.5%, whereas what it actually turned out to be was more than 8.5%, around 8.5%. So, I mean, good news for government, not so good news for the rest of us.
Yes, sir. Actually, since you touched on that, I thought I'll come to that later. I thought I'll stick to first the government finances. But Dr. Mundal, I mean, that is a little painful. I noticed that the GDP number has come back to FY20 levels, but per capita real GDP is still 1,000 rupees less than what the average Indian was earning or what the per capita income was 2 years ago. Does it show that somewhere there's more pain?
Yes, certainly. But first, let me congratulate you for an excellent summary of what the numbers are presented as. Really well balanced and quite impressive. On your specific question, yes, absolutely, and that is why you see that the one component of final demand, which has not caught up with where we were in 2019-20 is actually consumption expenditure, because that's why the per capita income has not caught up, so consumption is down. And this points, of course, to the increasing inequality, the great pain that has been concentrated in the informal sector and so on. We've been discussing this over and over again. And so this is very much along the expected lines.
Okay. Yes, I mean, Dr. Sen, just to come back to you, we don't, the CSO, you would know this much better since you headed it as the chief statistician, usually estimates the informal sector from the formal sector. So would you say actually the pain of the informal sector is even more than what the GDP numbers are indicating?
That's almost certainly the case. But Latha, you also have to remember something else. This is the first advance estimate. And the first advance estimate, unfortunately, has the disadvantage that the CSO only has data for 2 quarters of the fiscal. And the remaining 2 quarters are being projected, right? So the likelihood of error is much higher. The second advance estimate is better, which will come at the end of the month, because there you have data for 3 quarters. So at the moment, all they are doing is looking at the first 2 quarters data, and then they're essentially applying seasonality factors to project the second 2 quarters.
Fair point. And it's even more dangerous at a time when, the country is moving in 2 halves almost because of Omicron.
That apart, Latha, there's another important factor, which is the third wave of COVID. And it doesn't seem to have been factored in. It appears to have had zero effect as far as the projections are concerned.
Yes, I guess a lot of states have tried to ensure that economic activity is not impacted, but we are all, self-containing ourselves, and therefore some hurt on consumption cannot be ruled out. Definitely, you can't see so many vendors on the street, so the informal sector would have been hurt. But now let's come to what the market and the formal economy makes of it, and Nikhil Gupta represents that segment. Nikhil, what will the market or the India Inc. take away? The fact that the nominal GDP is better than what the budget estimated, the government has more fiscal space. So are there positive takeaways for India Inc.?
Thank you, Latha, for having me on your show. Latha, the numbers that have been released today, they are broadly in line with expectations as far as at least the real GDP growth is forecast. You mentioned in your presentation that it is similar to 9.3%, the market consensus. RBI was slightly on the upside where they were expecting close to 9.5%. We were at 9.1%, and it is around that level, 9.2%. What I think, which you touched upon in your beginning presentation, what would be more interesting to note is if this higher GDP, which is the denominator for fiscal deficit to GDP ratio, if it allows the government to spend more in the remaining of FY22. That, I think, would be the biggest question mark as far as something new or something unexpected, something that the market is looking at from today's number. Where I believe I'm not so optimistic that the government would be able to spend much higher than what the budget estimates are. Okay. And that is why I think broadly there is not much to read from today's data as far as the market is concerned.
Fair enough. But Nikhil, the other number that even Dr. Mundal referred to, personal finance, personal consumption, quite disappointing at 6.8. I mean, even our poll threw up a slightly better number. But this is not making up even for last year. Is there any even more negative takeaway for, consumer staples, goods goods heavily dependent on mass consumption?
Right. So, Latha, again, within the household sector of Indian economy, it's divided into 2 parts. One is the affluent household sector or the affluent class, which has actually benefited out of whatever we have seen in the past 2 years. And then there is the rest of the household sector, which we classify as MSMEs or the vendors who talked about, which is seriously affected. So we have done some analysis wherein we are pretty confident that the household sector has been severely affected in the COVID. Although, as I mentioned, there is one section within the household sector which has actually benefited. It is similar to what we are seeing in the corporate sector. The listed corporate sector has benefited. I mean, the financial position of listed companies is the best we have seen in the past many years. But the unlisted corporate sector or the aggregate corporate sector has actually weakened during the past 2 years. So similar is the situation in household. And then when we talk about the economy, of course, these unlisted corporate sector, the unorganized household sector, they are much bigger in terms of their contribution to the real economy. And that is where we continue to see the pain.
Fair enough. I mean, we can see it, all the Q3 advance estimates of FMCG companies. Why? In fact, Hindustan Unilever, even after second quarter, said that they see a big rural slowdown in consumption. And that seems to come out very clearly in the personal consumption numbers, just not able to make up for last year's deep cut, minus 9% last year. This time it is just plus 6.8. So we are consuming less than FY20. That is the message. Okay, Dr. Sen, if you were advising the government, what would you take away for fiscal policy? There is a little more fiscal space, but the added point is that, the tax collections have been excellent. Total tax collections is about over 50% higher than last year. And even if you did a 2-year CAGR to make up for the COVID year, it is still like a 25% per annum growth in taxes. So do you think these numbers, along with the tax collections, would give more fiscal space? Therefore, a fiscal stimulus, income transfer kind of budget should be the message?
Latha, the issue really isn't whether you need a fiscal expansion. I think what the government should be thinking about very seriously is the quality of their fiscal spend. That's where the problem is. What Nikhil was saying, I think, is something that we need to take on board very seriously, which is that large corporations are doing well. They are precisely the ones who pay taxes and therefore showing up in higher taxation. The point is, if the government uses this additional 65,000 crores to essentially spend in a manner which again benefits the large corporations, that's not going to help the economy very much. So it's the nature and quality of the fiscal spend rather than the quantum of fiscal spend itself.
Yes, income transfers perhaps, or labor-intensive projects like maybe...
This is correct. This is correct.
Okay, fair point, sir. Actually, I wanted to ask Dr. Mundal as well, what kind of tax buoyancy we should expect, given that, this year the taxes have done well. But that question after the break. We are back in a jiffy.